On the asset side of the balance sheet, you have two main headings. You can see there 1 and 2. One is non-current assets. 2 is current assets. Non-current assets, the first one, mean the assets which are used in the business for a longer duration, that is more than 1 year duration. That is non-current assets. Number 2, what you find there is current assets, those assets which are used in the business from 1 day to maximum 365 days. And those assets get converted into cash very soon, maybe weekly, monthly, bi-monthly, whatever. But within 1 year, usually they get converted into cash. So they're all called as current assets. So coming to the first one, non-current assets, you have A, B, C. You have under 2 current assets, you have 6 items. So I'll go one by one. So first, let me take fixed assets. Fixed assets are those assets which are used in the business for a period of more than 1 year. You can see here in this, there are 2 parts in fixed assets. One is tangible assets, other one is intangible assets. Let us try to understand the meaning of tangible assets. The tangible assets are those which can be seen, which can be touched, which can be felt by the people. So those assets are called as tangible assets. You have their examples starting from land, building, plant and machinery, equipments, furniture and fixtures, vehicles of any type, then office equipments like printers, computers, calculators, and so on. Then livestock. Livestock means stock of animals. Some businesses deal with animals, buying and selling. So those assets are called as livestock. So any animal for that matter, maybe usually they use for meat, or usually used for buying and selling, maybe chicken, maybe some other animals which are reared by the people, maybe cow, whatever. Next, cash, which cash is also tangible assets basically, which can be seen, because which can be touched, which can be felt. Then they are given work in progress. Work in progress means stock of work in progress. So the stock of work in progress also can be seen. And not only that, even the finished goods also stock that is therein, but that will all come under current assets. That's why they are given here capital work in progress. Capital work in progress means the building kind of a thing which is under construction, or plant and machinery kind of a thing which is under the setup, not yet completed. So anything connected to fixed assets, not finalized, not completed, that is called capital work in progress. Then coming to the intangible assets under fixed assets, intangible assets are those which cannot be seen, which cannot be touched, which cannot be felt. Only on records you're going to find those assets. Value of that you find on the paper. They are called as goodwill, brands, trademarks, computer softwares which you use, MS Office or apps, whatever the people use it. So many companies own many softwares they created and they are using, or they are purchased and they are using for their own. and different brands and trademarks. So brands are like names which are used by the companies for their products. For example, if you take cars, under each company car, you find different brands. For example, Maruti Suzuki, if you take, there are many types of cars. Any names can you remember? Then, okay, fine. Trademarks. Trademarks are symbols which represents the company and make the people to remember easily. For example, Nike, you find a tick mark. So like that, trademarks are also useful. They are all saleable, that can be sold for the various purposes to other companies. Next, the copyrights, patent rights, mining rights, that is mining connected to land wherein granites, oil, so that so many types of rights connected to usage of land itself. Then models, designs by manufacturing companies, licenses, franchisees. For example, you have Coffee Day franchisees, so they give away to others. So on franchisee basis only they collect franchisee amount to undertake that particular work. They enter into agreement and they collect minimum amount. They're all franchisees. So fixed assets have two types, that is tangible and intangible. So now coming to the next one, after tangible, intangible, non-current investments. So investments means where business invests the money in some other organization, maybe bank, maybe financial institutions, maybe government institutions for future purposes. So like savings. So you may also have fixed deposits. You may also might have invested in gold, silver, or land, etc. like that. So here companies also invest. So sinking fund investment, whatever the funds we have discussed in the last class connected to liabilities, those amounts, cash, will not be in the form of cash itself. They may invest somewhere in the government securities, mutual funds, some other companies, some other company shares, so maybe in some properties. So like that, they're all non-current investments. Then the next one is other non-current assets. You can see here, other non-current assets. So which are they? Okay, you can see here. Other non-current assets, long-term trade receivable, that is money receivable from customers, but more than 1 year. Then the remaining are losses. So usually other non-current assets are connected to losses incurred by the company. They are called as capital losses. So capital loss will be shown as an asset for the company shareholders, because profit is a liability because company is supposed to pay to the shareholders. Loss is the money to be received from the shareholders. So loss is an asset, but which cannot be converted into cash. So other non-current assets are nothing but losses incurred by the company. Earlier, the name for this was called as miscellaneous expenses and losses. So from miscellaneous expenses and losses, now they are converted into other non-current assets. So preliminary expense is one, underwriting commission, brokerage on issue of shares, discount allowed on issue of shares and debentures. So like that, usual ones are B to E items which may come under other non-current assets. So if you want to know the meaning, I'll explain a little bit for you to make you understand the meaning of those words. Preliminary expenses are those which are incurred by the company for the formation. When the company to be formed, various legal formalities to be followed. So money spent for bringing the company into existence will be called as preliminary expenses. So because it cannot be deducted from income, because it has been incurred much before starting of a company. So they are shown here. Every year, a small portion of that will be transferred to profit and loss income statement, so that the losses will reduce every year, because these amounts are very huge usually. So for that reason, maybe 5 years, 10 years, according to the rules of the company, they will transfer the money to profit and loss, like depreciation. You have a heading there, depreciation and amortization. So if these items are reduced, they are called as amortization. Underwriting commissions are connected to issue of shares. If the public do not buy, someone else will buy it. So an agreement is entered into by company with others. So for them, taking for the risk, they pay underwriting commission. Then brokerage is also similar, to attract the shareholders to buy the shares or applicants to buy the shares. Many brokers will be there, so they will helping the company for sale of shares. So for them, brokerage is paid. Then discount allowed on issue of shares and debentures. Sometimes companies in losses, company will not be able to attract people to buy the company shares and debentures, then they give away at discount. So they're all very important from your point of view to remember. They're all nothing but losses. If you have a copy there, you can edit or you can write down in your notebook. So non-current assets are nothing but losses of the company. Then coming to the current assets are those which can be converted into cash within a span of less than 1 year. So we have 6 items there, A to F. A is current investment. Current investments are those which are invested by the company, wherein you are going to find the investment is converted into cash within a year, less than 1 year. As I told, when the money is available, companies will try to invest in other company shares. If they keep it for a long time, that becomes a long-term asset, non-current asset. If they convert those into cash, or again buying and selling in the share market, so they're all current investment. So investment in shares and debentures of some other company, buying government securities, buying mutual funds, investing in some other companies, they're all current investments. Then inventory. Inventory means already you know, inventory means stock of raw material, stock of finished goods, stock of work in progress, stock in trade. Stock in trade means organization which buy and sell the goods. They don't manufacture. For them, it is stock in trade. Then stores and spare parts. Many manufacturing companies keep some spare parts for repairing the machineries, equipments, and so on. Next, loose tools, which you find in the home also, maybe a screwdriver, maybe a spanner, like that. They're all hammer. They're all going to belong to loose tools. Again, a manufacturing companies keep those. Then goods in transit, that is goods sent by the company, not reach the customer. That is also called as goods in transit. There's a one. Next, trade receivable, when the business sell the goods on credit to the customers, or services on credit, the money is not received by the company immediately. That money is called as trade receivable. Trade means buying and selling. So on selling the goods, money not received is called trade receivable. You have it as bills receivable, trade debtors. Okay. Provision for doubtful debts will not come here straight away. We will be deducting from debtors, not as a main heading. Next, cash and cash equivalents. Cash and cash equivalent, which are equal to cash. That is cash in hand. Then company may have fixed deposits. Company may have some money in current account, and company may have checks, DDs, drafts, all those in the hand in the company, which can be converted into cash within a day or two. So they're all going to be called as cash equivalents. Okay, so that is going to be the one very important for you to understand. Next is short-term loans and advances which company has given to somebody else. That means company has given some time before, so now they have to receive that money. The money to be received is called as short-term loans and advances, like the advances given to suppliers for supply of goods, loans given to employees, advances given to employees, and short-term loans given to maybe directors, maybe someone else, some other companies, any expense prepaid. I give an example there, prepaid insurance, like prepaid rent, prepaid salary, all those comes under short-term loans and advances. So we can also take it under other current assets also. Okay. Next, other current assets which do not come under any of these five will be called as F, other current assets. So interest to be received on investment. So like that, dividend to be received. So all those things comes under other current assets. So these are the usual ones. But one note is there, last one, you can see contingent liability. It is not seen in the balance sheet. It will not appear in the balance sheet. But liability which may arise, which may not arise due to various reasons, happening of an event, not happening of an event will not be in the hands of the company when it is not clear, when it is not finalized, but there may be a possibility of loss. So that amount will be kept aside, called as contingent liability. So sometimes some court cases are going on against the company. So company feels that they may lose the case in the court. So then they have to pay some compensation to someone else. So all those are called as contingent liability. So these are all the various amounts which comes under assets, what you see therein. Okay, any doubt?